Welcome to the webinar, Profit Repatriation for Singapore Headquartered Companies, brought to you by Nair & Co. in collaboration with IE Singapore. A few event notes before we get started. The link to today's presentation will be sent out to all registrants within 48 hours of this event. At the end of this webinar, we will have a short Q&A session. Please ask questions via the questions box in your GoToWebinar control panel at any time during the event. We will do our best to get these answered in the Q&A discussion. Any unanswered questions will be addressed by a speaker directly via email. I would now like to introduce to you our panelists for today. Our first panelist, Mr. Venkatesh Ishwaran. Venkat heads the Global Services Operations of Nair & Co. and oversees the delivery of all client services. Venkat is an expert on India inward investment and acts for a variety of private equity and VC firms, in addition to multinational companies of varying sizes. He is a qualified Indian chartered accountant and tax expert and has more than 22 years of experience in multi-country management, accounting, audit, and has assisted transnational organizations and leading Indian enterprises across sectors on regulatory, tax, financial, and business advisory related matters. Our next panelist for today, Mr. Anup Pense. As the head of Nair & Co.'s R&D department, Anup leads a team which oversees the preparation and up-to-date management of the company's research templates across all service areas and the technical updates for clients. Anup leads an important role within Nair & Co. given our commitment to a high level of technical competence and expertise. Anup has over 10 years of experience in research, taxation, foreign exchange regulations, and audits. Finally, I would like to introduce our speaker from IE Singapore, Ms. Kit Kerr. Ms. Kit Kerr is a senior manager with the International Marketing Activities Program Office Unit of Customer Services Group in International Enterprise Singapore. IMAP provides support for companies to access business opportunities when they participate in trade association and chamber-led trade fairs and business missions. In her 6 years career with IE Singapore, she specializes in managing various incentive programs to support companies' international plans. She's a certified Lean Six Sigma Black Belt holder. She has worked for several process improvement projects using Lean Six Sigma methodologies. Ms. Kerr holds a bachelor's degree of business management with double majors of finance and accounting from the Singapore Management University. Before joining IE, Ms. Kerr worked in KPMG Corporate Finance Singapore in the valuations team. Now I will ask our first panelist for today, Mr. Venkat, to start his presentation. Over to you, Venkat.
Thank you, Anuja. I'm going to be speaking regarding why your tax structure matters, what are the common pitfalls you need to avoid, and what are the transfer pricing issues you need to be aware of in the next 15 minutes. Subsequently, I'll hand over the mic to my colleague Anup, who would be speaking on foreign tax credits and why India and China are special cases. Why your tax structure matters. Why do you form a holding company structure? A holding company structure is essentially formed as a major economic consideration to optimize the taxes. To optimize the various amounts of taxes which generally the revenue authorities levy in form of dividend tax, capital tax, withholding tax, and also try to minimize the compliance cost. The business reasons for forming a holding company structure is the ease to enter a particular country, expand in various geographies, and exit businesses. That's the business reason, and also to enter regional, various regions. What are the various tax structures which matter, and do you really need to have tax structures when you're operating from a low-cost jurisdiction like Singapore? Is an obvious question which people ask. I get asked that question very often. The answer to that question is you do need to have a tax structure, and it really matters even if you're located in a low-cost jurisdiction like Singapore. Since Singapore, the tax treaty is what is very important when you actually come to repatriation of profits or taking money back home from a foreign location to the holding company's jurisdiction. Surprisingly, Singapore and US do not seem to have a tax treaty. So dividends, if distributed from a Singapore subsidiary to the, from a US subsidiary to a Singapore parent, would attract a withholding tax of 30%, whereas if the US subsidiary distributes dividend to a UK or a Netherlands parent, then there could be no withholding tax, and this is primarily because of the operation of a tax treaty between those jurisdictions and the US. Similarly, Singapore does not seem to have a tax treaty with Brazil, which is of quite an importance today. You also need to be careful about the tax implication on remittances in the home countries, because that could have significant cost. Singapore imposes taxes on foreign sourced income in case the foreign jurisdiction, the income is not subject to tax in the foreign jurisdiction, or the headline tax in the foreign jurisdiction is less than 15%. You need to be aware of those terms. One size fits all policy does not work for holding companies, since the different countries and different regions have different favorable holding company destination. If you want to enter Europe, it would be prudent enough to have a holding company based in Netherlands or the UK. Similarly, Singapore would be the normal choice for a holding company destination if you're looking at expansion in ASEAN and Asia region, because obviously Singapore offers a lot of benefits. Similarly, entering India could be from Singapore, since Singapore offers the same capital gains benefit as Mauritius offers, though very few people seem to be aware of it. And you never need to ignore the hidden tax costs, country-specific tax costs, which actually are generally ignored, is the withholding tax is not the only thing. There are country-specific tax, like India levies a tax on dividends distributed by companies, and that tax charge could be around 16%. Brazil levies a tax charge on capital inflows to Brazil, which is called the IOF. It's a federal tax levy primarily on transactions involving foreign exchange, insurance, loans, or financing, and on security transactions. The applicable rate for the transaction could vary between 0.38 to 6%. Tax treaty network also matters on deciding on holding company destination. For example, UK has got tax treaties with about 120 countries, whereas Singapore has got tax treaties with 70 countries. If you take care of your withholding tax rate and you look at the tax treaties, is that the only thing you need to decide when you evolve a tax structure? The answer is no. There are a lot of parameters you need to look at. There are destinations which provide benefits like patent box, innovation box, which give you favorable treatment and much greater protection when you actually house your IP, and R&D benefits by Singapore government for companies based in Singapore is well known, and a lot of companies do take benefits. Special economic zones set up by China and India are utilized as benefits by a lot of companies. Similarly, there are certain jurisdictions which also provide tax exemption for holding companies, or reduced compliance requirement for holding companies which follow certain norms. So all in all, a lot of things need to be looked into while you are actually evolving a tax structure. It's not only looking at one thing, it's probably taking a balance and matching of the risks and the benefits. Compliance and litigation costs also need to be factored in when you're going into jurisdictions which are developing countries like Brazil and India. You obviously need to encounter a lot of compliance requirements, increased amount of filing requirements, and also the aggressive attitude of tax authorities. Like India is very prominent in that the tax authorities are quite litigative, and there are a lot of litigations in India and a lot of gray area which seem to be challenged by tax authorities. Similarly, India also unfortunately has the distinction of changing tax laws very often, making frequent changes. There is a talk of even trying to change or tweak the Mauritian-Indian tax treaty, and if at all that happens, and if the new provisions actually limit the benefits of the capital gains exemption which is provided to investments which are coming from Mauritius, obviously, that will have an impact on the foreign investment which flow down to India. What are the common pitfalls you need to avoid when you actually do a holding company tax strategy? The common pitfall you need to avoid. Knowing the federal tax rate itself is not all sufficient. You would know that the baseline tax rate, the headline tax rate for a particular jurisdiction is so and so, but that could be other state and special levies which could significantly alter your total taxes you pay. For example, in Germany, the tax rate can vary from 23% to 33% in Munich based on the city due to the trade tax. Location of a company within a particular country can also significantly alter the tax burden. US has state taxes in many countries. Even city taxes for cities are levied in US. Similarly, the tax, you never need to ignore that. Are tax benefit exemptions while repatriating automatic? No. You need the repatriation of profits back to the holding company jurisdiction is not automatic and subject to certain terms and conditions. There could be terms and conditions like in France. France allows repatriation of profits to EU parent only if the percentage of holding of the parent is 10%, at least 10%, and the holding has been held for at least 2 years. So, if that condition is not met, then dividend distribution would suffer a withholding tax. Similarly, there could be documentation requirements which are necessary, and you need to ensure that all those documentation requirements are fulfilled. That could be certification requirement, like India needs a chartered accountant certificate while making a remittance. That needs to be done. So it's necessary for you to ensure that you do not ignore the documentation requirements while repatriation. You also need to know that the ease of tax administration. It would be heartening to know that Singapore actually is ranked as number 5 as per the World Bank ranking on the ease of tax administration. Number 1 is taken by UAE, obviously because there are no taxes in UAE. Hong Kong stands at 4 and Singapore stands at 5. Surprisingly, UK is 16th and US is 69th on the ease of tax administration, and predictably you would find India, China and Brazil actually come up at making up the rear. India stands at 152, China at 122 and Brazil at 156. It's not surprising because India, China and Brazil are most complex and difficult countries with a lot of regulations and requirements to adhere to. All this could significantly increase your compliance cost administration. Is the documentation required proper? You need to ensure that you have adequate documentation like the tax residency certificate, profit repatriation documents to ensure that you are able to claim the necessary exemption, or also the foreign tax credit is claimed. If you do not have proper documentation, you tend to lose this, and that could be resulting in a serious cost. Indian government requires tax residency certificate for you to prove that your holding company does have significant business and your foreign jurisdictions do have. Similarly, you got to be careful of CFC and general anti-avoidance rules, which is called GAAR. CFC provisions are currently implemented in USA, UK, Germany, Japan. It's also proposed to be implemented in the direct tax code in India. Singapore does not have a CFC provision currently. CFC provisions are rules which are designed to limit the artificial deferral of tax by using offshore low-tax entities. And if you leave your profits offshore and do not bring it back to the holding company, then there is a way they try to capture it and try to levy tax on it. Similarly, the general anti-avoidance rules allow the tax authorities to look into various arrangements and agreements, understandings, and identify any possible tax avoidance. The tax authorities could look into for the real substance and disregard the form. It could be the trigger point for implementing GAAR has been a matter of very hot debate across the business world. There are certain jurisdictions like Australia which are quite relaxed while they look at implementing provisions of GAAR. For example, a sole or dominant purpose is obtaining the tax benefit coupled with a lack of bona fide non-tax purpose is what would trigger the provisions of GAAR. Whereas in some jurisdictions like UK, it's very strict. If the UK authorities feel the arrangements have been contrived to achieve abusive tax results, then even if there was a dominant business purpose, they would possibly go and attack it and try to invoke the provisions of GAAR. GAAR provisions are very necessary to be looked at because they generally have a treaty override. What are the transfer pricing issues you need to be aware of while you're repatriating profits? When we say profits, I don't mean only the net income. I normally mean when you're repatriating surplus funds or monies back in the more wider context, monies or funds back from the subsidiaries to the holding company. Now, how do you remit the funds back from the subsidiary to the holding company? It could be in form of interest on a debt which has been given by the holding company. It could be in form of royalties or fees for technical services. Obviously, you need to ensure that you follow an arm's length price and are able to justify that the rate at which the holding company is being remunerated either on a debt or for services rendered is at arm's length and something which a normal non-associated commercial two parties would possibly be giving the same rate. It's necessary to ensure that you take care of thin capitalization rules. So in case if you have a heavy debt component in your portfolio and then you have an interest rate which is quite high and which cannot be justified, the revenue authorities in the foreign location could disregard the excessive interest paid as not a business expenditure, and that could impose liability on you for tax in those jurisdictions. Similarly, royalties and fees are something which is heavily debated, heavily challenged. That is seen as the rates are generally challenged in most of the jurisdictions where the countries are developing like Brazil and India, but because the tax authorities see that as an easy target to hit at, and it's necessary for you to ensure that you have sufficient documentation to prove the rate of royalties you have paid and the reason why that particular margin has been paid, fees has been paid as royalties, and is that the same? You would have paid a non-associated third party. Now, is there any way where you can ensure that you do not get into all this litigation with the revenue authorities and I have certain sort of stability to my operations and certain certainty to the profits which I'm going to be disclosing in foreign locations? Yes, the answer is yes. There are advanced pricing arrangements possible. What do you mean by an advanced pricing arrangement? Advanced pricing arrangement are normally agreements which you would like to make between your subsidiary and your holding company, where you are remunerating the holding company or any associated company for fees or services, and you go to the revenue authority before you actually start invoicing each other and get a confirmation from the revenue authority that that particular rate is arm's length and the revenue authority is in agreement with that. So if that can be done, why don't each and every company, why doesn't it go and do it? The answer to that is it's not quite easy to do it, because the cost of doing advanced pricing agreements in some countries can be quite prohibitive. Like Germany charges 20,000 euros for an application fee itself for an advanced pricing agreement. So unless your transactions are of such a volume and such a value that you feel that 20,000 euro fee is something which I'll be able to give, you would possibly feel that it's not worth it. Similarly, the advanced pricing arrangements are generally for a period of 1 or 3 years, and then you got to keep on renewing them. Denmark is quite common as a popular jurisdiction where advanced pricing arrangements are very cheap and very common. In India also there are advanced pricing arrangements since July. It offers. China also offers, but then it's not as simple as you do it in Denmark. Are there safe harbor rules? Safe harbor rules is again a sort of an agreement where the safe harbor rules, you have, if there is a margin of say 5% between the rate at which you remunerate your holding company and the rate at which the revenue feels you should have remunerated, and if that margin is around 5%, Brazil possibly allows you. There are certain other jurisdictions which allow varying percentages as safe harbor. So if the variance between what the revenue authorities feel should be the arm's length price and the price at which you have normally contracted, if that is within that permissible limits, then possibly punitive action will not be taken against you. But if that is above the that particular margin, then punitive action could be resulting. Transfer pricing documentation. Transfer pricing documentations are very important, not only to know what it is, but also to get the benefits in various jurisdictions. India is very strong on transfer pricing documentation. You need to have a documentation for every transaction above a certain limit. You need to have transfer pricing audit done by an independent chartered accountant firm, and they got to give a specified report which details the various transactions and what are the methods which have been applied to arrive at the transfer price margin. Similarly, transfer pricing audits are also done by revenue authorities in most jurisdictions to ensure that we are the profits being declared as correct. The transfer pricing documentation also could be in local language in certain countries like China and Germany, so it's necessary for you to ensure that you take care of all those. Thank you very much for listening, and I hand over to my colleague Anup to discuss why India and China are very special cases, and also he will discuss to you briefly on the foreign tax credits and how you can take it. Thanks very much. Over to you, Anup.
Good afternoon, everybody. I'll take you through the slides for why India and China are special cases. In recent past, India and China has been a hot destination for investment from various countries, especially Singapore to India route has been very hot. After Mauritius, which has a lot of treaty benefits with India, it has been Singapore who has been investing a lot in India. About 10% of India's FDIs come from Singapore for last many years. The basic issue with India and China has been the documentation. As I mentioned, for India and China, there are numerous documents required before you repatriate any kind of, if you can repatriate any kind of profits to your parent company. There are no exemption available from this. As for India, as you can see, there are a number of documents which I have listed on the screen. This documentation does not only take your time, but it also takes a lot of expenses, because you are required to have chartered accountant certificate, audit record, various document, completing various documents. Similarly, the authorized dealers with from whom you can only send money from India to abroad may ask for certain more documents. Besides these documentation requirements, India required to hold higher withholding taxes in India if the foreign company does not have a permanent account number, which is a tax registration. Now this applies even if you do not have any physical presence in India. So if you do not have a permanent account number and you are remitting royalty from Indian entity to Singapore entity, the withholding tax can go as 25% instead of the routine 10%. So it is absolutely advisable for every company to obtain a permanent account number in India. Similarly, I have given a list of documents required for China. As you can see, I'll literally require a different presentation to cover all the requirements in China. I have covered some of the major documents in the presentation. The second important flaw or the problem with investing in India and China is frequent law changes. The tax laws are still evolving for globalization and is come in line with OECD and OECD as well as the developed countries. In recent past, in India, in budget in March 2013, the finance minister prescribed that tax residency certificate is not going to be enough to claim the treaty benefits. Now this resulted into a lot of protests from investors community in India. Thus this was withdrawn later on. The plan was to give assessing authorities, tax assessing authorities, more authority to ask for whatever documents they want to prove the tax residency. However, this particular provision was withdrawn later on. However, there was one change in the law in March 2013 which has become effective now, is increasing withholding taxes for royalties and fees for technical services. Earlier, all the royalties paid from India used to be taxed, used to be subject to withholding tax of only 10%. Now, in many countries, it has increased to 25%. However, this is not a worry for Singapore parent company. It was always 10% and it will remain 10% for withholding tax on royalties and fees for technical services. Similarly, China recently changed the VAT regime across most of the provinces. Now, business tax and VAT, which was there in China, will be clubbed under the new VAT regime. These are the changes one need to watch for. Second thing is that there are certain unique taxes in India and China and other developing countries, which have significant implications on your tax cost. I have mentioned the royalties and fees for technical services, which are subject to withholding tax. Over and above that, it is subject to service tax in India, which is levied at 12.36%. So this will increase the tax burden substantially. Similarly, I can take example of business tax in China, or which is now VAT. There is 5 to 6% of VAT levied on royalties paid from China to abroad. So one needs to factor in this cost along with the withholding tax in order to optimize your tax cost. Numerous and constant litigations, the key problem in developing countries, India being amongst the top. So in recent past, India has been ranked #1 in terms of litigations over transfer pricing. So one needs to watch for litigations in these countries, which again can add significantly to the tax cost. Now I'll touch base on what are the best practices for profit repatriation strategy. The first point is very important. Having thorough knowledge of local requirements is necessary. Venkat has already mentioned that there is a dividend distribution tax in India, which is about 16.995% or 17%. Now, most of the people investing from abroad know that there is no withholding tax on dividends in India, but then it is compensated by 17% of the tax. So effectively, your tax cost remains high. Similarly, one needs to be aware of CID in Brazil. This is a tax which is levied on services remitted from Brazil. You know, it includes even royalty. So if royalty payment is going from Brazil to a parent company abroad, 10% CID will be applicable, which will increase the tax cost. Brazil also tax extra to certain lower tax jurisdictions, which includes Singapore. So even if the withholding tax rate on a particular royalty or on dividend is low in Brazil, it will be much higher in for remittances to low cost jurisdictions like Singapore, Hong Kong, and other jurisdictions. Yeah, the next point is also very important to note that merely knowing tax law is not enough. Other taxes, other laws have their implications. Like for declaring dividend from China and India, you need to set up a reserve before your profit is repatriated back. So in China, 10% of your profit needs to be kept aside till the time your reserves reach 50% of paid up capital. Then only you can declare the dividend as you want. So similar provision exists in India. So one needs to watch for other regulations as well, like company law, foreign exchange regulations, before deciding on what can be repatriated. The last question I asked in the presentation is very important. Most of the people are aware that limited liability partnership in India do not have dividend distribution tax. So effectively, they are tax effective compared to limited liability company, which has 16.995% of dividend distribution tax. But that is not all. Forming an limited partnership, liability partnership in India requires approval from Central Bank of India, which is Reserve Bank of India, and that may take significant time and approval may never come. Instead of that, a limited liability company in most of the sectors can be set up in a couple of weeks. So one needs to take a call not only based on what the tax benefit is or what the tax cost is, but one has to look at other regulations as well. Next is proper documentation and compliances can significantly improve the tax plan. As I mentioned, if you are having substantial reserves in your China subsidiary, you cannot simply declare a dividend and get your money back. You have to complete a lot of documentation, which will involve time, which will involve cost. So it's not like developed countries where you can simply declare a dividend and wire transfer the funds. You have to go through a lot of process. Similarly, though Brazil does not have any regulations on remittance of profits, but there is a registration requirement. There is a special electronic system where you need to register in Brazil. The next question again is important. It is essentially to integrate your business plan with your tax strategies. Is it required that all the money you earn in a particular holding company destination to be remitted back? It may not be necessary. If you are having a holding company in UK, you may explore UK as a market itself. Or if you are having money in Netherlands, you can use those funds to invest in multiple other countries, because Netherlands has a lot of favorable tax treaties across the Europe. So it is always need to be decided whether accumulation of funds is better or repatriation is better. This also can result in your tax deferment to a substantial extent. As Venkat has mentioned, there are a lot of provisions like CFC and GAR norms. Now those are not uniform across the countries, so you need to see how best you can fit in. Like Venkat mentioned, UK is tougher than Australia, so you can flex your agreement a bit in Australia, but UK you have to be having a very watertight agreement. Similarly, whether you can consider APA option. Like in China in 2010, there were only 8 APAs which were concluded, so possibly it may not be worth the effort. That's why companies are not going for APAs in that country. Whereas in many European countries, it's very common to have an advance pricing agreement, and one should go for that to avoid any kind of uncertainty to future. I have already touched based on documentation requirements, so I'll not take much of your time. For most of the profit repatriation, one has to document the agreements, which should be very well drafted, because it will be always verified for arm's length pricing by transfer pricing authorities. You need board resolutions. You need to maintain tax deduction and payment documents. You need to maintain for foreign tax credit purposes the documentation. Not having a document can result into penalties, fines, and actually losing the tax benefit. So this is a very important area. Now the last but not the least topic is foreign tax credit. Whenever you are expanding out of your country, you always need to take into mind that there will be foreign tax credit related issues. Foreign tax credit essentially wipes off the double taxation effect. So a particular income may get taxed in India and then the same may get taxed in Singapore again. This can be avoided through a foreign tax credit. For foreign tax credit, the main benefit is generally found in the tax treaties which the country has. But tax treaties is not the only solution we have. Many countries provide for unilateral tax credit. Like if India doesn't have a tax treaty with country X, then India will still grant a foreign tax credit under Section 91. Singapore tax law also provides unilateral tax credit. So which will reduce your tax cost to a certain extent. However, one has to keep in mind whenever you are claiming foreign tax credit, your tax cost, overall tax costs are going to go up. Very important thing to check always is whether what taxes are covered under foreign tax credit. It's not necessary that on every tax you pay you will get a credit. Like in India, you may get credit for minimum alternate tax, but you will not get for surcharge or dividend distribution tax. So that will be your hardcore tax cost. I have taken an example for elaborating on the methods which are available for foreign tax credit. As we go ahead, you can see it in details. I have highlighted the portion specifically saying that the tax costs are always likely to go up when you are taxed in multiple countries. So best way is to avoid getting taxed in multiple countries. So your tax structure always has to plan in a way that you don't have to claim a foreign tax credit, wherein your tax cost will always jump up. Tax sparing clause is very important. What tax sparing clause does is that if some income is exempt in one country, it is also exempt in the parent company country. Now, if that exemption is not there, then the exempt income will always get taxed in the parent company's hands. India and Singapore doesn't have a tax sparing clause in their tax treaty, but India and Japan even has tax sparing clause. Ensuring that tax sparing clause is very important in countries like in India and China, where you have special economic zones. Like in India, tax can be exempt for 15 years in a special economic zones. Now, if this particular income which is tax exempt in India for 15 years gets taxed in Singapore, it's meaningless. So one has to check for this tax sparing clause. I've jotted down some other factors which can affect your decision. One of the factor I can consider is that the year end may not be same. So essentially, Singapore parent company may be closing its account on 31st December, so 31st December 2012, whereas the subsidiary in Australia may be closing its accounts on 30th of June 2013. So effectively, that 6 month period will always be under question. So if you are filing Singapore return in April 2013, that is before Australian books are finalized, then how you will be sure of the foreign tax credit which you can claim? Similar issue lies in terms of what currency rate one can use, whether it will be year-end rate or it will be the rate at when the tax is actually paid. This kind of matters look small but can have significant cost implications for a company operating across the globe. I have taken an example here which I think is simple enough. All I have tried to elaborate that without foreign tax credit, I mean if the foreign tax credit would have been fully available in an ideal situation on $200,000 income in a country, our country, you will end up paying $60,000 of tax at an effective rate of 30%. But as for foreign tax credit methods are not ideal, it may result into effective tax rate increase to 31,000. You will end up paying more $2,000 tax. So you can just take a look at what is there is in our country. For $40,000 is made in country S, and the tax imposed is at 30%. So the credit you are going to get is $12,000 instead of $14,000, which should be the ideal credit, and you end up paying $2,000 tax more. Thank you very much for listening to me on this presentation. I'll now hand it over to Ms. Kitkar. Thank you very much. Kitkar, over to you.
Hello. Hi, good afternoon. This is Colleen. I'm from Customer Service Group. Ms. Kitkar is currently away for a business trip, so I'll be sharing with you on our IE assistant to the SME today. So a quick introduction. A quick introduction of IE. We are the agency driving the external economy through trade and internationalization. So in 2012, Singapore offshore trade generated 1.16 trillion in turnover and a total export of goods amounting to 510 billion. Export of services was 149 billion and our direct investment overseas reaches 29 billion. So internationalization is necessary for sustainable long-term growth for businesses. Singapore company can do that by growing operations overseas through trade and internationalization to reconfigure global activities, to ensure suitable activities remain in Singapore to take advantage of our current environment. Or they could also relocate other activities to area that has lesser constraint in terms of labor and land. From the internationalization survey in 2011, SMEs and large companies actually derive more than 50% of their revenue from overseas investment. We also see that in the 2012 Singapore Thousands rankings, the overseas revenue has actually grew to 29.4%. As seen on the slides, we have 38 overseas centers. Typically, our strength lies in the ability to spot opportunity in emerging countries, and we typically the first to set up in unfamiliar territories to capture first mover advantage. The latest addition to our global network is actually our overseas center that we opened in Ghana. So the next slide actually shows where are all our offices. Through the ground market insights that we obtained in our office, we have seen how the increase in competition, the volatile global economy, and interest in emerging markets have necessitated the need for a closer engagement with our Singapore company. So it's critical for Singapore to have Singapore-based globally competitive companies, which is the GCCs, to ensure that sustainable growth for them in Singapore and overseas. They play an important role in our economic ecosystem. These are companies who are headquartered in Singapore with globally competitive products or services and have significant global presence. Our mission is actually to help this company grow overseas and build their international footprint. Through internationalization, we hope this Singapore-based company will become GCC, and they also benefit Singapore in terms like creating jobs for Singapore, stimulate business activities, increasing the industry competitiveness, and growing the Singapore brand. Okay, for IE Singapore, we are committed to help all Singapore-based companies, regardless of their size and sector, to be GCCs. So what makes a good GCC? IE Singapore will help willing and able company, whether big or small, to grow into GCC as long as they possess the following factors: a leadership with global aspirations and mindset, clear internationalization plan in mind, a unique product and services, as well as generate potential economic benefits to Singapore. So how do we assist the companies? IE Singapore, we take a twin approach to help Singapore company restructure and grow into GCC through the two program, Market Readiness Assistant, MRA, and Global Company Partnership, GCP. MRA offers a broad-based assistance solution suite to companies looking to restructure and establish overseas operation. It consists of a wide range of tools for companies to help them learn about new market and basic know-how when going abroad. Whereas GCP is a customized, in-depth approach to help grow companies strategically overseas. So the next few slides, I'll be sharing with you on the framework of MRA. How this program actually benefits all companies, starting with companies who are new to internationalization. So the first pillar is actually information, where we offer company assistance in getting business intelligence on overseas market. We actually have Market 101 guides available on IE website for companies who wants to know business setup issues like taxation, corporate entities, and licensing labeled in overseas market. Also, at Bugis Junction Office Tower Level 10, we have our iAdvisory Center where company could come in to talk to our officers as well as conduct their research using research database that we subscribe to get hold of the latest global economic development and generate business leads for their business. IE itself, we also produce IE Insights where we have market and industry focused report providing timely updates of the economic environment in the country. Last but not least, we are also the official source of Singapore trade statistic, and our published statistic covers trade volume and value of Singapore bilateral trade for all commodity in both HS and SITC code. The next pillar will be on learning. So in the learning pillar, we offer companies workshops and seminars to gain practical insight, and these are conducted usually at IE Singapore headquartered at Bugis Junction. So we have the export strategy workshop that will help company identify key challenges, helping the company to develop the right export strategy. And country-focused seminars will be actually our advisory seminars, where we give practical insights on new market opportunity from government officials, industry experts, and sharing by successful companies who have ventured overseas. Continue with that, we have the advisory clinic to offer classroom training on sharing of operational issues in terms of taxation, legal, manpower. For exporter, you can also access online self-assessment toolkit to learn about your internal capability, such as your financial strength, export experience. So by completing the export readiness assessment on our IE website, you will actually receive a report sharing with you. So we also have invited logistic providers to share in our export clinic to help you gain understanding of the technical skills and administrative knowledge required to manage your export operations. Lastly, we also conduct free trade agreement workshop for you to tap on the FTA in your business and know more about how useful it can be in your export journey. In the last pillar of our MRA framework, we have the financial assistance provided to our Singapore-based company. The MRA grant actually launched in this year, 1st of April, provide pre-scope professional services for market assessment, market entry, and business restructuring through internationalization. So interested company can access our website for the participation list of partners providing these services and the application. On top of grant, we also have tax incentive where company could enjoy 200% tax deduction on eligible expenses for qualifying market expansion and investment development activities. Our International Marketing Activities Program, IMAP, is provide funding to companies to participate as part of the Singapore Pavilion at various overseas trade shows for you to reach out to others overseas buyers. Through the Local Enterprise and Association Development LEAD program, we work with the trade association and chambers to strengthen their business capability to bring companies on overseas mission and trade shows. The earlier slide were for companies who are new to internationalization. Now I'd like to share with you how our program can benefit companies who are already in the market using the GCP framework. So for GCP, we actually have 4 various pillars, starting with the first one will be capability building, where we support capability building activities up to 50% of the third-party eligible costs. So supportable activities are shown in my next slide, such as branding, design, IP management, social media, franchising, and licensing. So company can apply the support of up to 50% for third-party consultancy costs to build relevant capability strategy. Particularly for branding, design, and IP management, the support has been raised up to 70%. Next pillar under GCP is on market access, where using our network in 38 offices worldwide, we provide first-hand insights on global trends and valuable government contacts. We also have platform projects for companies to participate, as well as activities that we support under our grant scheme. So the supportable activities will be such as market research, first-time overseas marketing offers, feasibility studies, merger and acquisition. Similarly, we support up to 50% for third-party consultancy fees. And for MMA activities, the support has been raised up to 70%. Under the third pillar in GCP is our manpower development support. So as your business expands globally, you may face increasing human resource challenges, especially in the area of talent attraction, talent development, and internationalization human resource strategy. So in talent attraction, we ensure a steady supply of talent through the university by providing internship and international sourcing for mature talent. So we have programs such as IBF, the International Business Fellowship, to provide overseas training. Under talent development, we also support customized training program by third-party provider when you send your key talents into this market immersion initiative. Last but not least, you could also engage third-party consultant to help you develop an international HR strategy to avoid any common international HR pitfall. In our last pillar of GCP is on access to financing. So access to capital is actually crucial for global expansion. Our credit enhancement scheme will facilitate your access to capital from participating financial institute. So we have the scheme like the Internationalization Finance Scheme, IFS, where company can access to capital facility to be used to purchase fixed asset used abroad, working capital for projects, or the loan insurance scheme where it provides short-term trade financing facility. These are administered through participating financial institutes, which you can access to the list on IE website. We have the political insurance risk scheme to protect overseas investment and project against political risk events which may adversely affect your financial position. Trade credit insurance scheme is to help the company against any non-payment by your buyer when you extend credit terms to them. So this scheme are administered by insurers registered in Singapore. Thank you very much for listening to my presentation. So should you have any further questions or queries, you're always welcome to contact us at 1-800-IE Singapore, or you can email your queries to enquiry@iesingapore.gov.sg. We also have our advisory center at Bugis Junction Office Tower Level 10. You're always welcome to visit us. Thank you for your attention. I end my presentation. Over to Anuja.
Yeah, thank you, Kaylin. That was very interesting and informative. We have received many questions during this webinar. Let's go through as many as possible. Venkat, I have a question for you. It says, you mentioned that India-Singapore tax treaty benefit for capital gains. Is this the same as Mauritius?
Yeah, it's a very interesting question. Obviously, yes. The answer to that is yes. Similar to the India-Mauritius tax treaty, when a Singapore company sells shares of an Indian company, no capital gains will arise in India. However, before you go ahead and start doing that, please ensure that such a beneficial tax treatment is available to a Singapore company only when it passes the LOB test. What is an LOB test? The LOB test is supposed to be a limitation of benefit clause, which is inserted in the tax treaty between Singapore and India, which is not present in India-Mauritius, is that the limitation of benefit clause is an anti-abuse provision aimed at preventing treaty shopping. So this benefit of capital gains tax exemption in India will be available only if the company is listed in India or Singapore, or a company which has spent around Sing dollars 200,000 or its equivalent in Indian rupees 5 million of annual expenditure on operations in Singapore during the preceding 24-month period. The reason for this is to ensure that you do not form shell companies in Singapore and try to avoid capital gains tax in India. There is a talk going on that Mauritius and India will also have a similar limitation of benefit, but however, at present, the limitation of benefit clause is only available and is seen in the India-Singapore treaty and not in the India-Mauritius treaty. I hope that answers the questions.
Thank you, Venkat. Anup, I have a question for you. can you please explain what is higher withholding tax in India if there are no specific numbers?
Yeah, the specific number is called permanent account number, as I mentioned. It's a 10-digit number which every non-resident is advised to obtain, because though it is not mandatory, but if you don't have that permanent account number, your withholding tax rate is going to go up. The withholding tax rate, the penalized withholding tax rate will be 20% to 25% depending on the nature of the transaction. Obtaining PAN is a time-consuming process, but as it has become essential in recent past, the tax authorities have been responding quickly. So every recipient of money from India, even if they do not have a presence in India, should obtain a permanent account number to avoid higher withholding tax. So I think
Anup,
that should
thank you very much.
Yeah.
Thank you very much, Anup. I have another question for you. I think this will be our last question for today. Is there any specific relief for documentation from China or India into Singapore?
There is no documentation benefit from China or India to Singapore, to my knowledge. India doesn't provide any kind of documentation relief for remittance to anywhere abroad. From China, I think there is a tax benefit available for repatriation to Hong Kong. That too only you can avoid having tax residency certificate. And that benefit is also available in certain provinces of China. It is not across China. I think that should be the answer.
Okay, thank you so much. I don't think we have time for more questions, but we will definitely get them answered directly via email to you. Thank you so much, Venkat, Anup, and Kailin. Our participants would have greatly benefited from this extraordinary depth of information presented today. Thank you all for attending today's webinar. I wish you all a lovely afternoon.
Thank you very much. Thank you. Thank you for listening to us.